Well, I'm gonna tag a little bit on what my colleagues here have said, Steve and Josh, and I'm going to come at it from another point of view. If you think about where the 10-year should be, we've actually seen a decline in the 10-year over the course of the last month. And quantitative tightening is coming. It is happening. But look at the dot plot. Where are we supposed to be by the end of the year? 3.25 to 3.5. And the 10-year is still trading below 3%. So I actually think the bond market is going to be able to digest some of this quantitative tightening, even at the accelerated pace that we're talking about, a little bit better than expected. Second thing, the U.S. dollar. We laugh a little bit about it because we're all expecting to hear a lot of comments about constant currency. Constant currency doesn't pay the bills. But we are likely to continue to see the dollar at least stabilize and perhaps even depreciate slightly, just given the inflation numbers that we've seen. I think that we're overlooking the positive progress that we've made in inflation over the last 6 weeks or so. And I think it's come primarily within energy, and I'm not denying that food prices continue to remain elevated. To Josh's point, rents are elevated. But this pace, this trend, will create consumer confidence and a shift in sentiment that is likely to continue to drive services demand. And I want to make that clear. I do not think there's going to be a huge explosion of goods spending. I think some of the stories that we've seen from places like Target and Walmart are going to persist because it's services spending that I see accelerating. But this delay in demand that we've seen, I don't think it's distracted. I think it's delayed. As far as where do we go in the back half of the year, you know what's coming up? Midterms. Lots of things are happening right now. Lots of things are happening in Washington. A lot more movement than we were anticipating. So if you look at September and October, don't discount the fact that we're going to hear a lot about the economy, that consumer confidence could actually pull back a little bit, be depressed a little bit by the political rhetoric. But I do think that November and December are setting up for a nice rally into 2023 because I think earnings expectations have been too low, and we are anticipating a deep recession, which is not going to come, at least in the first half of 2023.
So, Shannon, very quickly, you're saying we're overlooking the easing of inflation, but the inflation numbers are down, but they're not down incredibly. I mean, you look at PPI, it's down 0.5%. So if we're overlooking it, what number of inflation do you think that people need to pay attention to and really hone in on that you think is going to be beneficial for the markets?
I think we're discounting the importance of gas prices being down markedly for the last 7 weeks. That is a huge part of consumer confidence. And although the basket remains expensive, we have to think about the behavioral reaction of driving by a gas station and every day seeing those prices come down. It is anchoring to a new reality that I don't think that we have accounted for in terms of our expectations for consumer spending on services in the third quarter, which was weak in the second quarter, but could really help from a GDP perspective in that third quarter print.
Yeah, gas prices down 7% over last month, according to CPI. Degas, over to you. Real rally, head fake, where you at?
Well, one of the things that we have to remember that September is historically a down month for the market. And to just go along with the rest of what the panelists are saying is that let's look at the overall market where we are. And for instance, earnings have surprised on the upside. So that's a positive. We have a strong labor market. And then ultimately, we have to now look at how will the consumer be impacted. Shannon brought up a good point. As energy prices come down, as gas prices come down, there's going to be a positive consumer sentiment that we will start seeing. But likewise, we're going into the midterms that could cause some volatility around the market. So what I'm seeing is that the market could pull back in the fall, but ultimately we're seeing a relatively soft market at this point. We may be in a trading range, but ultimately we're seeing this market still being positive. So what we're looking at is that we're still staying within our discipline of focusing on those companies that have reasonable valuation, that have positive expectations, profitable companies, and are good corporate citizens, because in the long run, that's what's going to work for your portfolio.